Hey guys, this is Nick from Financially Aware, and in this video I want to explain how stock, debt, and bankruptcy work. And I'm going to start very simply and then get a little more complicated, and then I'm going to kind of show how this works in the case of Hertz to show you guys why there's no value left in the stock at this point in Hertz. But this works for any company, whether they're in bankruptcy or not, who gets paid first and who's in the hierarchy and how it works. So let's get started. So since I love pizza, let's say you have a company and that company is a pizza store, right? You invest $50,000 of your own money in this pizza store, you own it completely, and you just manage it. You know, you hire all the workers, they do everything, you don't work there, you don't take a salary. And every month, you know, you put in 50 grand to start it up and buy all the equipment and everything. And every month, it's profiting you $4,000. So each one of these green rocks is $1,000. So in your company goes $4,000 every month, right? Next month, you make another $4,000. So this money is just building up in the company until you take it out as a dividend or profits or whatever, right? So you keep doing this for a few months, and then one of your friends tells you, hey, I hear you're doing good with that pizza place. You know, can I buy into it? And you go, yeah, I'll give you 50% ownership. You know, it's making $4,000 a month. I'll give you 50% ownership for 50 grand. And the guy goes, 2,000 a month times 12 months, 24,000 a year. That's almost a 50%, you know, gain on my money. That sounds like a good deal. So you go, okay, I'm going to give you half the company. You give me 50 grand. He pays you 50 grand, right? And then what happens is now there's common stock. You guys both own stock in the company. Before you owned 100% of the company. Now you own 50%, you're equal partners. Now, of course, before that buyout, you took out all your profits out of the company, right? Put that in your pocket, and then said, okay, the company's making $4,000 a month. We're even partners. So next month comes, $4,000 comes in, and your partner says, hey, you know, I'd like to take my profits. And you go, okay, well, if you're taking yours, I'm going to take mine. So 2 for you, 2 for him. Right? Next month, same thing. 4,000 comes in. You guys want to take your profits. You take them out as a dividend, right? This is what a dividend is. You're sharing in the profits of the company. And so as soon as these stockholders get their dividends, they take it and go spend it on whatever they want to go spend it on, right? So there's the dividends. Now it's gone, right? So after a while, you guys start to think and you say, hey, this is going really good. Why don't we open another location? And so you go, yeah, let's do that. So you find another location on, you know, some other city or something like that. And you happen to know people in the pizza business. And so you go to a guy that knows the pizza business that's really successful. And you say, hey, can you lend us some money to start another location? And the guy goes, yeah, how much do you need? And you say, okay, we need $40,000. So he goes, okay, he gives you $40,000, but just like a bank or if you sold a bond, he says, look, what are you going to do with that $40,000? We're going to buy ovens, we're going to buy computers, we're going to buy furniture and stuff like that. So he goes, okay, look, I'm going to buy that for you, but that's going to be secured to that loan. So if you don't pay that loan, I take that equipment and stuff back. That's the security. So just like a mortgage has the house as security or a car loan has the car as security, if you don't pay that loan, they take the asset back. So he goes, okay, here's your 40,000, but it's going to be, you know, it's secured debt. It's going to stay over here. It's not something you can spend. I still own this, and you guys pay me interest on it. And so they go, okay, that's fine. And he goes, oh, by the way, one other thing. He goes, you have to pay me, right? Say the interest is $2,000 a month on that debt. He goes, secured debt is now over here. I'm next to the cash register. You guys are now down here, downstream, right? So it flows down. So if the company is making, you know, $4,000 before they open the second location, that $4,000 goes, okay, it goes here first, and then it goes to these guys as a dividend, right? But let's say that location starts and it's not doing so good, and you guys start to get behind in the debt to the food vendors and vegetable vendors and stuff. That's unsecured debt. So they're also right next to the secured debt above the common shareholders, right? And so let's say that's now $3,000 a month, 2 for the secured and 1 for the unsecured. Now your first store is still making $4,000, but your other store is losing $5,000, let's say, because it's a bad location or whatever. There's construction going on. There's not a lot of traffic. You know, you picked wrong. So you guys are now losing $1,000 a month total, but you still have to pay $3,000 to 2 to your secured and 1 to your unsecured creditor, right? Now, you guys are coming out of pocket for this. You don't have to do that. You could say, hey, look, we can't pay that. And what's going to happen is the secured debt is going to say, okay, well, now I have to take you to bankruptcy. If you can't pay the debt, and what a lot of people don't realize is that most mortgages, commercial mortgages, residential mortgages, bonds, they have covenants in them. And one of the most common covenants is if you miss one interest payment, they have a right to demand the full loan amount. Okay, so if you have a $300,000 house and your payments are, you know, $1,500 a month, if you miss one payment, they have a right to demand the full $300,000 immediately, otherwise they foreclose on you. And that's the same thing with secured debt and bonds and things like that. So that's why these companies go into bankruptcy, because if they miss one payment, they're technically in default and they have to file bankruptcy, and the company that lent them the money can demand the full amount of the debt. So in this case, if you can't pay, right, this guy goes, okay, well, I lent you 40 grand here in equipment, right? Let's go to bankruptcy court and let's see, you know, what we can do. Well, let's say this $40,000 equipment, it's now, you know, it's used. And so if you sold it, it's only worth $30,000, let's say, right? So let's say the secured debt says, look, let's make a deal here, because I know the second store is a bad location, but I know pizza places, and I know the first store is still making money, $4,000 a month. It's just the other store that's dragging it down. So he goes, okay, look, I'm gonna take over the first store. Maybe I'll pay off this unsecured debt. You know, I'll make him a deal and offer him, you know, half of what he's owed, and he'll be happy to take that. And by the way, these two guys are no longer the owners. Right? And these guys go, but wait a minute, look, I have common stock. I'm a stockholder in this company. And this secured guy goes, okay, that's fine. Pay me my 40 grand and I'll go away. And these guys go, well, I don't have 40 grand to pay you. And so he goes, okay, that's nice. You guys go away, and this guy is now the new owner of this company. And so he shuts down the second store, keeps the first store, and runs it, and he's making his 4 grand a month or whatever. And that's how that works with common stock. If you get into debt too much, it doesn't matter how much stock you own or what price the stock is. If you as an owner cannot pay your debts, then the person who holds the debt now is entitled to try to take everything you have in that company to pay off the debt. And if it doesn't pay it off, you know, they could just take the whole thing and say, okay, look, it's only going to pay us a little bit. We'll just take the whole company. Now, If it was a little different and the secured debt said, hey, let's sell everything, and it turned out that selling everything got you, got the secured debt paid and the unsecured debt paid, and there was, $4,000 left over, then the common guys would get two each, whatever's left over, and then that's it, and the business is closed. So that's how it works. But usually the reason you go into bankruptcy is because there's not enough to pay the secured debt and the unsecured debt. So that's why there's usually nothing left over for the common shareholders. So let's look at the case of Hertz. Let's say this was Hertz, and this is their unsecured debt that they currently own in bankruptcy, $4 billion about, right? So they sold $4 billion in bonds, and they owe vendors and whatever. So let's say they got $4 billion, right? Now, the secured debt is the cars, and this thing is untouchable by other creditors, okay? So if these guys can't get paid, they take this and sell it, and whatever they get goes to satisfy their debt, and if there's any money left over, in other words, if this doesn't satisfy the $14 billion that they're owed, then any other money they have has to get paid to them before it goes to any unsecured debt. Now, if the unsecured debt is $4 billion and they only pay off $2 billion, then that means the shareholders, common stockholders, get nothing, because there's not enough to pay off the secured first, then the unsecured, and then the common stockholders. And so what Hertz is doing now is they're going to be adding more common stock. So normally, right, if you have your company's operating good and you have, $3 million, let's say $3 a share per year, right? So that $3 a share after paying off all the debt goes right to the shareholders, let's say in dividends, right? Shareholders get $3, right? But what's Hertz doing now? They're going to offer another 248 million shares when they already have 142 million shares, right? So that's almost like diluting your company by 60%. So what that's doing is, instead of this amount of stockholders, right, whether it's, whatever, 142 million, now you're going to have, almost 400 million. And so here's how the dilution works. Before, those $3 a share went right to these guys, right? But now there's going to be more shareholders, and so it's going to have to be even to each one. And that's what dilution is. Okay, you're adding more shares, and so you have to spread the profits over the shares. But in this case, there are no profits. Okay, so all they're doing here is really just trying to sell some stock to give these guys just a little bit extra money, in their unsecured and secured debt. Nothing is going to flow to the common stockholders. And if you think about it, right, in the case of the pizza, the two guys that own the stock, when they owed $40,000 to the other guy, they could have just paid the other guy and the guy would have went away. That's the same thing with Hertz, right? The shareholders, if they really want the company that badly, they can go ahead and pay these guys off, right? Let's say the secured debt pays for itself when they sell all the cars, and there's just $4 billion left for the unsecured, right? Well, if you want to, if all the shareholders agree and they say, okay, let's pay off this debt so it doesn't go bankrupt, and that way we'll still have our stock. Well, what would that look like? Okay, like I said, there's 142 million shares outstanding, okay? And there's $4 billion, let's say, in debt that's not going to be paid. So what that means is each one of these shareholders would have to come up with about $30 each per share to pay off this debt. while the stock is trading at like $3. Okay, so there is, in a nutshell, the conundrum of people that think this thing is going to come back or something like that. And the other thing is, if you think like, okay, the airlines are opening back up and they're going to be back in business and stuff like that, I got news for you. Okay, the fourth quarter of 2019, Hertz lost 119 or something million dollars in their earnings. So that was before any kind of pandemic, any kind of shutdown, just a regular quarter, they lost money. Now, yeah, they make more money in the summer for sure and all of that, but you know, there's just because they're opening up a little bit doesn't mean they're going to have $4 billion to come up with to pay off these guys. So if you are so adamant that you think, you know, by buying the stock, it's somehow going to come back and all of that, yeah, that's if you as a shareholder are willing to pay up $30 per share to bail out the unsecured debt that is owed by Hertz. So how many of you out there want to buy a $3 stock and add another $30 per every share you have to help bail out Hertz? Yeah, I didn't think so. So that's kind of how it works. And so I hope this kind of cleared things up and kind of, you know, made you realize that there is no great story coming up on Hertz and the big turnaround and all this stuff. And what this new stock offering is just really just a money grab to give these guys just a few more dollars on their bonds, but nothing for these guys. So, you know, like I said, stay away from it. There's nothing but trouble, and you're not gonna you know, turn this thing around or anything like that. The stock is going to get delisted soon, and it's going to end up where all these bankrupt stocks always end up, which is zero. So even though the stock is going to zero, like I said, that doesn't mean the company is not going to operate anymore. And this is the biggest confusion that people have. So they go, look, Hertz is too big, they're going to keep working, they're going to reorganize and all that stuff. Yes, that is true. But this is what's going to happen, okay? You still got these stockholders here, right? Current stockholders. These secured and unsecured debt, they're going to try to, the secured debt is going to sell some of these cars down to get to a more manageable level. And like in the example of the pizza, you know, they're going to close some locations, they're going to get smaller, maybe they're going to have less cars on hand for less demand, right? And after all that's done, there's still going to be debt that needs to be paid. So they're going to talk between themselves, and they're going to say, okay, this is what we're going to do. You get this percent of the new company, and you get this percent, whatever. And then we're going to rip up this debt, right? Get rid of it. And now you got a company with no debt or very little debt that's smaller and more, you know, nimbler or whatever, and only keeping open the profitable locations. But these guys got to get something for wiping out their debt. What do they get? They go, okay, these guys are gone, and we are the new stockholders. You know, these guys are really the new stockholders of the reorganized company. So yes, there's still going to be Hertz stock, but it's going to be new Hertz stock. The old stockholders get wiped out. The debt holders get, you know, give away their debt. They say, we're going to turn our debt into stock, and that stock is going to be the new stock that the debt holders are going to own, and the old stockholders get nothing. And that's how the reorg goes most of the time. And so that's the trickiest part that people have a hard time understanding, because they go, oh, this company came out of reorganization and now it's doing good, it's $50 a share and stuff like that. Yeah, that's because the debt holders turned their debt into stock, and the old stockholders got nothing. So thanks for watching my video. If you like this video, give me a thumbs up, leave me a comment, let me know if I've convinced you that you shouldn't buy Hertz stock. And if you haven't subscribed, please subscribe to my channel now. Thanks for watching.